Nobody likes to see a red portfolio. I know what is the first thought that comes to your mind after seeing losses in the stock market. इससे अच्छा तो एफडी पे इन्वेस्ट करते था. But is it a wise choice? See, the stock prices are determined by the theory of demand and supply. A higher demand followed by lower supply shoots up the prices. But on the other hand, lower demand but higher supply brings down the prices. The falling stock market indices means a higher supply of stocks without sufficient buyers, giving buyers a higher bargaining power to bring down prices. So, why are there not enough buyers? Why are there not enough demand? Are the companies not doing well? Hi everyone, I am CA Panjal Agrawal, and in this video, let us understand what is happening with the stock market and what should we do next. We all know that coronavirus, the Russia-Ukraine crisis, has created a panic in the market. It has disrupted the supply chain and ultimately raised the prices of all the commodities, causing all-time high inflation. Now, in order to stabilize the economy, central banks all over the world have taken measures to curb this problem by changing the rate of interest and making borrowing expensive. As a result of which, business and even individuals would delay their spendings, which would reduce the supply of money and ultimately help to curb inflation. Think it like this. If you are being charged an interest of say 20% on your car EMIs, you might consider waiting till you find a cheaper means of finance. The companies would also delay their expansionary plans until the situation is under control. Thus, rising the interest rates reduce the overall supply of money from the economy, resulting in lower demand for shares and leading to fall in stock prices. Thus, recent actions like increase in interest rate by 0.5% by US Federal Reserve and actions by RBI like increase in 40 basis points in repo rate and 50 basis points in cash to reserve ratio have increased the cost of borrowings for companies as well as for individuals. The risk premium of investing in the equity market has declined substantially, and foreign institutional investors have pulled out their money from the equity from US and other emerging markets like India. This has increased the supply of shares and reduced the demand, causing the stock market to fall. The pandemic is not yet over. We are in middle of a war. The fuel prices are under pressure and the supply chain is disrupted. Inflation is skyrocketing. To add a cherry on the top, Indonesia has temporarily banned the export of palm oil, affecting the FMCG sector of our country. All these factors have created a panic amongst investors, causing the stock market to dive from 60,000 points to 54,000 points. But is it really a cause of concern? Should you also make an exit from the market? First of all, let me tell you, all these factors are just temporarily influencing the demand and supply of stocks, leading to fall of indices. They have no relation to the performance of the companies which we continue to hold. Although they might impact the business temporarily, they pose no threats to the long-term prospects of the companies. When we invest in any company, we are not betting on the short-term prices of the shares, but we are investing in the business and expecting it to grow over time. We focus on the results of the company. If you have a look at our portfolio, you will realize that despite all the disturbances, the companies are performing exceedingly well beyond our expectations. As a PMS, this isn't the time to be concerned for us. As our companies are performing well, it is the market sentiments that are driving the prices down. And this impact will be temporary. Trust me, we would be concerned when our companies aren't performing well, but still due to market forces, their prices are soaring. So, we have no reasons to worry. When our companies are doing better, their fundamentals are improving consistently, and even if market is facing hardships, market is bound to recover sooner or later. Let us have a look at PCBL Limited. The stock prices have crashed by almost 25%, while as per the latest results, you will see that revenue has gone up by approximately 70%, with very consistent operating profit margins. You will see growing net profits along with higher EPS, and this company is now trading at a PE of just 8 times. Similarly, another company which is a part of our HQRP portfolio is Orient Cement Limited. The stock is trading around its 52-week close, but the latest results say that revenue and net profit have gone up by over 17%, with very consistent margins and substantial reduction in long-term borrowings. This stock, again, is trading at a P of just 9 times. We also have Make Money Organics Limited, whose revenue grew from 700 crores to around 2500 crores in just 3 years, have consistent margins, and is trading at a P of just 10 times. So, what does this all mean? When you are invested in quality stocks, the current stock market situation can be considered as a huge stock market sale where you can get heavy discounts on your favorite brands. I want to ask you, what is there to be worried about? Instead of panic selling, we encourage you to continue with your SIPs and we strongly advise you to invest in lump sum. Even if you aren't invested with us, we recommend you to stay away from the companies with high debt, companies that are endlessly loss making and are burning cash because the future for them is truly unpredictable.